I'm Niels Christensen. Welcome to Kitco News and our continuing coverage of Mines and Money Online Connect Virtual Mining Conference. Gold prices continue to hold near their highest levels in 8 years. Here to talk about his outlook for the precious metals is Lachlan Shaw, Head of Commodity Research at National Australian Bank. Lachlan, thank you very much for joining us today.
My pleasure.
So gold, it's on a tear. Everybody's sort of looking at 1,800. Do you think the price is ready to break out? I mean, we've had 3 runs at this major resistance level. Is it ready? Does it need something more? What are your thoughts on the price action that we're seeing right now?
Yeah, it's a great question, and it's a question we field a lot at the moment from clients who are key stakeholders in the gold trade. Look, I think at the moment gold is really walking a bit of a tightrope between a number of key factors. And if I sort of lay it out and highlight, in the bullish corner, if you will, I guess the broader macro backdrop that we're seeing at the moment. And that really is the risk around the post-COVID lockdown recovery. And that risk really is playing out in terms of, resurgence in COVID cases in a number of key countries and regions globally. And the risk around that really is, if the health situation deteriorates, what do businesses, governments, individuals, what do they do about that? Do they retreat into their shells, if you will? And if they do, that pretty clearly has negative impacts or potential negative impacts on that growth recovery. And following on from that, if that was to happen, then clearly we would likely see existing stimulus that has been unleashed into the financial markets by central banks around the world, as well as governments. That existing stimulus would be in the market for longer. Nominal interest rates likely to be at current very, very low levels for longer. Or indeed, we could see more stimulus. And all those factors normally are very bullish for the gold price. And coupled with that is safe haven demand. And that traditionally has reflected a range of different factors over time. It's reflected concerns around trade wars, geopolitical concerns, US-China tensions. Now it's starting to reflect a little bit, I think, the resurgence and spread of COVID-19. So on the one hand, you've got those bullish factors. And if you look at all those bullish factors and you look at the growth in central bank balance sheets and government to debt to GDP ratios, I think you would conclude that in the medium term, there's some very strong tailwinds for the gold price. But then in the other corner, on the bearish side, it's a combination of things. It's a combination of the potential for more rapid COVID recovery. And so again, if we see individuals, businesses, and governments make, more consumption and investment decisions sooner because confidence is returning, that lays the foundations for a faster, more of a V-shaped recovery, and that would start to sow the seeds of an earlier retreat in central bank stimulus and government support. And that would likely be, as I say, a bearish headwind for the gold price. But then, overnight, and at times in the last 3 months, we've seen the other bearish factor for the gold price, and that is a bit of a flight to US dollar liquidity, right? And so gold is walking this tightrope right now. And to be honest, on my reckoning, looking at the market, I think that tightrope's likely to be the dominant trading reference for the foreseeable future. Exactly how that pans out, I think will be very data dependent and very dependent on emerging trends in COVID-19. But then beyond that, I do believe, if you look historically in recent decades and you look at times when central bank balance sheets, government debt to GDP ratios really expand dramatically, as they have done in the last quarter or so, that lays the foundation for a very strong lift in the gold price in the 1, 2, 3 years following. And I do believe that's my overarching framework that I'm thinking about in terms of the gold price into the medium term. Massive central bank balance sheet, massive lift in government debt to GDP ratios, the question around monetary debasement, all those factors in previous cycles, for example, the GFC, we saw massive central bank balance sheet expansion then, and that led to a very strong rally in the gold price 1 to 2 years later. And so I think we're looking at the potential for the same sort of pattern once we sort of get through the next 6, 12 months. And so I do think the gold price will crack 1,800. I don't know if it's in the short term, but I do think it will. I do think the price cracks 1,800. And indeed, I think it will probably head towards $2,000 an ounce on a 12 to 18 month view.
Mm-hmm. So I guess right now in the short term, then you're seeing sort of fair value for gold in these balance between, sort of optimism of a better recovery versus the inflation fears and debasement fears of all this money printing. So would you say we're fair value then?
I think that's probably fair. Again, it has this feeling of a real tug of war, if you like, between these two competing forces right now. There's not real conviction out there, and it is very much data dependent. As we're seeing, we're seeing recent weeks, the trading action has followed, real sort of news, data, and COVID catalysts. And so I think, again, until we get beyond that, be it a better COVID treatment regime, be it vaccines that we hope we will eventually have in place, which would then allow the focus to sort of shift from how COVID is interacting with economic growth, and then the focus of the gold market would shift to, well, we have massive central bank balance sheets in play. We have huge increases in government debt to GDP ratios. And the reality is reversing those things is really, really tricky. And again, as we've seen in previous cycles, gold often does very well in those setups. So I'm not quite sure I'd say fair value, but it's certainly, as I say, it's caught between these data and news cycle bullish and bearish trends right now.
Mm-hmm. Okay, so turning away from gold, what commodity looks good to you right now in this environment where we have so much disruption, both on the supply side and the demand side? What commodities do you like? What would you say investors should be looking at?
It's a good question, and we just put out our latest quarterly outlook last week, and in that, I think the factors I've talked about with you in terms of central bank balance sheet, massive liquidity expansion, government debt expansion, again, historically, the conclusion that those drivers support commodity prices is not just the case for gold, it's also the case across the commodities, the commodity complex. So in that vein, we like base metals. We're certainly quite positive copper on a 12 to 18 month view, really because of the prospects for sustained economic recovery and growth, given the massive stimulus that's been put into the global economy. But also given that the fundamentals right now for the copper market are certainly not slack. If you look at inventories in China, they're down. If you look at recovery for fabrication and construction in China, it's lifting strongly. If you look at supply for copper and taking into account the spread of COVID-19 in South America, particularly Chile, we see an increasing number of key assets in Chile operating on skeleton staff. They are not doing maintenance. They are not doing mine pre-stripping. So the risk is that if COVID infection spreads, those operations will have to slow down production, which is bullish copper price and bearish supply. But B, going into next year, the longer these assets defer pre-stripping, the higher the chances are that production next year has to fall. Right? If you don't pre-strip, you don't access the ore, and obviously you can't produce. So I think the copper market is actually set up pretty nicely. And if I look across the broader base metals complex, we would highlight similar dynamics in broad terms for nickel. Zinc's a little different. Zinc does look as though we're seeing now more supply coming into the market. We're seeing inventory start to lift, and that may prove to be a relative headwind for the zinc price. And aluminium, same sort of argument. We're now seeing increases in LME aluminium stocks. The carry trade is very much in play, and we're not seeing production start to cut back in line with reduced demand. But in broad terms, we do like copper. And then also in the energy space, I don't know if energy is in your remit, but certainly from the point of view of many in your audience, producers particularly, we do expect the oil price to lift by 30 to 40% on a 12 to 18 month view. The wheels in motion for rebalancing there are very much in play. OPEC and Russia and friends have taken a huge amount of supply out of the market and are remaining disciplined. And even though we're starting to see US production coming back into the market, the demand recovery is enough to put the market on a day-to-day demand-supply balance today into a deficit. So we do expect to see, in coming weeks and months, we expect to see that massive inventory build observed in first quarter, second quarter. We expect to see that start to fall. And as we draw down those inventories through next year, that's the catalyst for oil prices to continue to recover.
So put your feet to the fire a little bit then. So we have oil, copper, and gold. How would you rank them? Which one do you think is going to be the stellar for the rest of the year?
Yeah, that's a good question. Look, if I had to rank them, I would say, well, I would probably rank in terms of potential for appreciation of prices from here, from current spot levels. I'd probably rank copper, oil, and then gold. Again, I think the thing with gold is because there are issues around, obviously the COVID recovery, sustained recovery there. I think in the short term has the potential to weigh on the gold price as risk appetite is reallocated to other assets. Whereas I think recovery for COVID recovery for the copper market, for example, that's unambiguously a good thing, right? So I think that's the likelihood in the short term. But then medium term, I think all do well. Again, we're looking at just such a huge tailwind in terms of central bank liquidity, government debt to GDP, etc. I think the one commodity, if I was to sort of highlight one that I'd be looking at interested in on the short side would be iron ore. The iron ore price is back up to 105 US per ton delivered into China. It's above marginal cost. The trade is tight today. I think on a 12-month view, the trade does start to ease up, and we expect prices to fall back. So iron ore would be my pick on the short side. But yeah, apart from that, again, we had the benefit from a broader macro perspective. We've just had this incredibly deep negative economic shock. We've had prices respond accordingly. Prices, obviously for most commodities fell. We've had governments respond appropriately, putting in place enormous stimulus, but it will take time for that stimulus to come through. And that stimulus, in a way, I think it will be the tide that lifts most boats. And so hence, as I say, if I look across the commodities we cover, we're pretty positive on a 12 to 18 month view on most things.
Fantastic. So I guess the key takeaway is look more long term.
Yeah, certainly for the gold market, as I say, I feel it's difficult to have conviction today on where we go. Just because the cycle right now, the pricing action is so news and data dependent, and I feel in many ways the COVID recovery is going to be a case of 2 steps forward, 1.5 steps back, or 1 step back. It'll be this cycle of good news, bad news, good news, good news, bad news. And that makes it difficult to have conviction on the trade, certainly for prices that react to that sort of news flow so closely, like gold. But then once we get, as I say, and the assumption here is that we do get beyond COVID, we get treatments in place, we get potential vaccines in place, and the market's attention shifts beyond COVID to the shape of the inevitable economic recovery and to the massive amount of stimulus. And that's where I think we can probably take a bit more conviction that the gold price has a pretty good prospect.
Lachlan, this has been a fantastic conversation. Thank you very much for sharing your insights with us today.
My pleasure. Thank you.
Thank you for watching Kitco News. For all our coverage from the Minds and Money Online Connect virtual conference, go to kitco.com. Stay safe and stay healthy.